I was able to identify 55 people who had been in the restaurant before buying a house account and then after. And their spend per visit went up by 80% once they bought a house account. And we were able to look at, that cohort of 55 people, and we assign an annual value. So they come in once a month and they spend $10 a visit, so they're worth $120, right? And the total value of that 55 people was $31,000. Once they bought house accounts, their total value was $120,000 a year. So people come in way more frequently and spend a lot more.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside. Woo!
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Eric Hornung, and I'm accompanied by my co-host, Mr. Shrimp Quesadilla himself, Jay Klaus. Jay, how's it going, man?
What do you like about that curveball?
Yeah, you're in Austin, the home of the taco. We go to a taco truck, has great ratings, 5 stars. It's a little food truck. Oh man, it's literally across the street. I'm thinking about walking out of this intro and go getting one right now.
Granny's tacos?
Granny's tacos in Austin. Phenomenal. It's not Torchy's. I know everyone Torchy's, but we go over there and Jay doesn't get a taco. No, he gets a shrimp quesadilla.
I am counterculture. I don't conform to your taco norms. I'm here to eat what sounds good. I like seafood. I like quesadillas. I like large, self-contained foods. And, you've got like 9 tacos on your Twitter thread as of this recording. Like, I think that's gratuitous numbers of tacos. I've had a lot of tacos too. Sometimes I want to try a quesadilla, and I'd appreciate it if you got off my back about it.
You really come after me here. You also just said you like large, self-contained foods.
Yeah, like burritos, like gyros.
I know. I've just never thought about foods being large and self-contained before.
I like beige foods specifically. Anything that's beige, I'm in. If it's green, I'm a little wary of.
Let's dig deeper on it. Seriously, beige foods.
Yeah.
Like hot dog buns. You're like, oh, this is great.
Yeah, I mean, that's fine. I mean, a lot of grains, like, will be fine. But, you're talking about cheese, you're talking about fried things. Name something that's beige that you don't think that I would like.
Sand.
That's not a food.
Oh.
Beige foods. Yes! That's the silence that I'm looking for.
Yeah.
What I do like about tacos, and also gyros, really, is that it's a food that makes you eat it on its own terms. Like, it will be eaten, but you're still craning your neck, contorting yourself to make sure that you eat it without just spilling it all over yourself. I respect a food that dictates the way it's consumed.
So you don't eat your gyro with a fork and knife?
No. Do you?
No, I don't know. I don't know. Some people might,
All this food talk is getting me hungry. Bad news, Eric. We're going to be talking about food a lot during this interview.
For at least another hour.
Today we're talking with Johann Moonesinghe, the co-founder and CEO of inKind. inKind is a different type of restaurant financing. They've invented a new form of finance where they purchase a bulk amount of food and beverage credit upfront from a restaurant and then sell it to guests over time. The example that Johann gave us was that he has purchased large dollar amounts of credit in restaurants, an average of up to $100,000 for a discount, and then sells that credit to consumers as large gift cards, an average of $750 per, with a bonus.
I'm a little confused on the model. I think it's interesting, but I think we're going to dig a lot into a model here because it's just so different.
Very different. And I wonder, what the staying power is. I think it makes a lot of theoretical sense. It seems like it's a very capital intensive business up front with some real risk involved from like an inventory perspective, almost like an inventory of food credit. So excited to dig into that. inKind was founded in 2016. It's based here in Austin, Texas. It's raised $2.2 million from Techstars, Firebrand, and some angel investors. Previously, they had started a company called Equity Eats in 2014 that was an equity crowdfunding restaurant platform. And inKind is kind of the evolution of that.
Let's bring in Meredith Sugar, a partner at Taft, Stettinius, and Hollister, to teach us about preparing for an exit. Taft is a full-service law firm known for assisting entrepreneurs across the heartland. As a reminder, the following remarks by Taft attorneys are for informational purposes only and are not legal advice. This information is not intended to create, and receipt of it does not constitute an attorney-client relationship. No person or organization should act upon this information without first seeking professional counsel. Meredith, thanks for coming in today. How's your day?
Good. It's a little cooler than we'd like here in Columbus, but spring is definitely on the way.
I hope spring is on the way. I hope summer follows that, but in Ohio, you just never really know. Meredith, I wanted to give you a hypothetical situation here. Let's say I'm a founder and there's an acquisition offer on the table. It's starting to feel very real that there'll soon be a lot of money in my bank account. So how might I, as a founder, think about estate planning services?
Well, although an acquisition certainly encourages business owners to execute estate plans, the time to have engaged in planning is yesterday, if not now, whether or not an acquisition is imminent. Avoiding the time and cost of probate is generally very easy to do by having a trust, especially for business owners. The trust will hold all that person's assets, including their business. Many other good reasons exist to have a trust. For one, a trust can keep children from inheriting at the age of 18, holding their funds in trust, even though the funds are always there for their support until ages later than 18. Tax planning is another good reason to have a trust. We currently have a very high federal estate tax exemption of over $11 million per person, but this exemption likely won't stay this high, and in the past few years it's been as low as $1 million. Passing away with more than this amount subjects a person to a 40% tax. Trusts are able to make the tax scenario as favorable as possible, and more creative types of trusts can help with wealth transfer to lessen the tax burden even more.
Something that no one thinks about, but everyone should be thinking about: taxes. Appreciate you coming on. And if people want to learn more about Taft or yourself, where should they go?
Our law firm website is taftlaw.com, and I can be found on the site.
Johann, welcome to the show.
Thanks for having me.
We like to start on Upside with a background of the founder. So can you tell us about the history of Johann?
Sure. Let's see, I was born in Pasadena, California, born and raised there. Went to UCLA, studied computer science, electrical engineering, and then I moved out to Washington, D.C. to work out there for a couple of years. My freshman year roommate from UCLA called me and said, "Hey, Johann, let's start a company together." So I moved back to LA. We started a company. We had no idea what we were doing. You know, two of us didn't have much support from the community. Our families weren't super helpful. It was this tech startup, and it ended up failing in about 9 months. But we moved out to Boulder, Colorado to be part of Techstar's first incubator. And that was an incredible experience. So same founder, Doug and I, totally different outcome, and just like really, really made the difference for us was this incubator that we went through.
The first Techstars incubator, what year was that?
The very first, 2007.
Yeah.
Which was great because we got to become really close friends with the founders of Techstars. So David Cohen, Jared Polis, David Brown, and Brad Feld. Brad actually led our round in the company. It was called Madcast. We sold it to another company, and then I was kind of looking for what I was going to do next. And Jared had just won the congressional seat, and he was the first openly gay freshman congressman, which was super cool. So actually my best friend, Jonathan, who was our first investor in inKind, eventually he wanted to work for Jared on the Hill. So me and Jared's partner Marlon and Jonathan all drove to DC together, and I ended up out there, started investing in things, kind of like everybody who sells their tech company does, invested in tech companies, became an LP in several funds. So I was actually David Cohen started a fund that you guys probably know, invested in Uber and Twilio and SendGrid. So I was fortunate to be in that.
Wow.
Did pretty well. Did some real estate, and then started investing in restaurants just because I love food, love wine. A friend of a friend was opening a whiskey bar, supposed to be a high-end molecular gastronomy cocktail bar, and it's 2 blocks from my place in DC. I was like, I'm in, right? So invested in that, brought in some friends on that investment. About a year later, a friend came into the bar with me and was like, I wish I could invest in a restaurant. I'd come in all the time. And at the time, you had to be an accredited investor in order to invest in a restaurant. So my husband, who's English, the Defense of Marriage Act had just got overturned, so I was able to sponsor him for a visa, and he moved to America, and he's a lawyer. And I was like, I'm ready to start another company. Let's do it together. So the two of us, with two of our other friends, started a company called Equity Eats. And what we did was we crowdfunded for Equity, the first restaurant in the country. So it was prior to the Jobs Act being enacted by the SEC. So we actually worked with the DC government. It took a while, and a lot of regulation, but we were able to raise, I think we raised something like $400,000. No, we raised $250,000 from like 450 people who were all DC residents. And we actually started our own restaurant that was crowdfunded. And I kind of ran the restaurant plus Equity Eats for about 2 years.
How did you, from a platform or like logistical perspective, how did you guys manage that crowdfunding before the Jobs Act was out?
Yeah, so we had to build everything. So we had our own software developers, all the marketing side, like it was all brand new. So we were doing a lot of learning. I think we ended up spending almost $200 per investor just to market the the raise.
That's not atypical of crowdfunding though, to my understanding. For like some of the big crowdfunding campaigns, a lot of marketing spend and effort seems to go into it, even the reward stuff.
Yeah, absolutely. And for us, I think the biggest problem with equity crowdfunding for restaurants is that restaurants aren't that profitable. So even if you invest in a restaurant and it's doing really, really well and you invested $100, like if you make a $10, let's say, profit per year on your investment, which is pretty good, now you have to file a K1, with your taxes. And most people, like TurboTax, their version doesn't support filing a K1. So you have to spend an extra $30 for the better version of TurboTax, to pay the taxes on the $10 return you made. What we did find, though, that where people came in all the time, they still do. So the investors in the restaurant are there all the time. They bring their friends. They're really great marketers for the restaurant. And that's ultimately what inKind came out of, was this idea of, okay, how do we provide, and they were coming in and spending money. So I should mention that they were buying food, and then at the end of the year, we're paying them some small amount of money back. So we were like, this doesn't seem very efficient. What if instead of that, people just essentially bought food, and their return came to them in the form of more food, which for a restaurant, we have a ton of food and a ton of drinks, but we don't have a lot of cash, right? So it took about 2 years to kind of evolve from this pure equity crowdfunding to what we have today, which is inKind, which is really sort of all around cost of goods for food in a restaurant, and how do we play in that market?
Is $250,000 even enough to start a restaurant?
It depends where you're starting a restaurant, but what we did was we took over an existing space, but the answer is no. We had no idea what we were doing. So in that first year, I think we probably lost close to $500,000. And we'd only raised $250,000, so I put in the rest. And it took us about a year, which is normal for restaurants. You lose money in the first year, and the second year, you've kind of figured out what you're doing, and you hopefully pay back the debt from the first year. And then by year 3, you start paying back your investors. It's pretty normal.
I want to talk a little bit about this exit, because I think you're the first person who's come on who's exited to a scale where they just became an investor. How big was the exit, if you can say, or whatever you
disclose, but it actually wasn't a huge exit.
Okay.
It was, I guess it was enough to be...
Right. It was enough to not work, and it was enough to be an LP and to invest in real estate and to start up a restaurant. So it was like decently sized. What was that like? Like, what was exiting like?
Yeah, that's an interesting question. It was a long time ago. For me, it wasn't that much of a change in anything. So in college, that same roommate and I, we started non-tech companies, a non-tech company together. We sold paperback textbooks on Amazon, and that did pretty well. And then I actually imported and manufactured Montessori equipment in China. I was the first person to do that and bring it here. I've always been entrepreneurial and was able to make a little bit of money doing that. And so there wasn't really a change in my lifestyle from the exit, if that makes sense. Yeah, which is kind of a weird philosophy that I have just in general. Like, I'm not seeking an exit even for inKind. Like, eventually we'll exit it and it'll make a lot of money. But my lifestyle isn't probably going to change. And not that I have like an extravagant lifestyle. I just kind of keep a pretty mellow lifestyle, other than wine. I'll spend unlimited amount of money on wine.
For the listeners, we're literally sitting here with a bottle of wine that Johann brought us.
From a small producer in Australia.
Yeah, and it's fantastic.
And we're not just sitting here with it. We all have glasses of wine, just so everyone's on board. So if I start slurring my speech, that's what's happening.
Where did that entrepreneurialism come from? Was that a part of your family?
Yeah, I think it was. My parents are immigrants. My mom is a high school math teacher. She teaches calculus. And my dad sort of is a respiratory therapist, but he worked 3 jobs, when we were little to support the family. And both of my parents' families in Sri Lanka were entrepreneurs and had businesses. My mom's family, they had a music factory, and it was actually, there was a civil war in Sri Lanka, and it was destroyed, and the family had to leave as refugees. But I think as growing up, it was like there's entrepreneurial sort of spirit in the family, definitely. Like all my uncles have businesses.
Did you have like the lemonade stand as a kid? Were you trading like trading cards? Or did it start in college with the book thing?
No, I definitely did. Apparently, when I was like 2, I painted rocks and tried to sell them to the neighbors. And then I remember when I was really little too, I hired the neighbors and we started a gardening company where I was like too small to do the gardening, but I would, I guess, do the deals.
You said, I know inkind's going to be successful. We're going to make money. We'll probably exit. Have you ever failed in anything?
Yeah. So Zemble was the first company in LA that we did. And it really was my first attempt at anything as a pure tech company. And I remember we had no idea. We didn't know how to value things. We couldn't tell the difference between a convertible note or, equity, like none. There was a company called, I think it was Dodgeball that Google bought for $50 million. And it was a related kind of space to what we were doing. So some potential investor came in for a meeting and he's like, well, like, what's the valuation you're looking for? And I was like, well, if Dodgeball sold for $50 million, we're probably worth $70 million, And there's like 3 of us sitting here in a conference room. He's like, So I would say like, we just didn't have a lot of guidance or advice, from people. And that led to the failure. But I learned a ton from that failure.
And how quickly did you bounce back from that?
We actually sort of transitioned into the Techstars program and that company. So it was a failure in the sense we ran out of money and we couldn't pay anybody. So really just, Doug and myself and Tony, who was another developer, moved to Boulder to be part of Techstars.
What was Madcast? What was that business?
Yeah, it was a blog sharing widget, basically. So at the time, blogs were big. Now people don't really blog anymore. But the idea was you could go to different blog posts that you're reading. It remembered who you were. So we used cross-site scripting across sites. And we could, figure out, you could share something with someone via SMS or to Facebook or something like that. And we remembered that for the next time you went to a site that had our widget. So you could more easily share with friends that you'd already shared with. And then we could take that data and plug it back into an ad network to, if you're sharing things with someone, you're likely interested in those things.
Have you kept up with Techstars since you went through?
Yeah, so I'm actually an LP, I think, in 3 of the Techstars funds. David's a good friend of mine. Jared is a good friend as well. They're the biggest, Techstars Ventures is the biggest investor in inKind currently. And we just hired a principal from Techstars Ventures, Derek Keller, to be our CFO of inKind. So it's a very, John Fine came from the Techstars network. I'm an LP in his fund. He's an investor in inKind. So I think pretty close with the Techstars network.
What's changed the most since that first accelerator to now, besides size?
Yeah, scale, right? Probably in that first accelerator, David was the managing director. He was the guy sitting there with us for the whole summer. It was a startup for him, so he probably didn't really know, he'll say that, like he was making it up as he was going. But I think what the biggest benefit was we got so much time with the founders of Techstars and the mentors. And obviously now they have thousands of companies they're accelerating. They can't spend time with them.
You probably are a little biased here, but I've been a part of a lot of first round organizations as well that I think there's something invaluable for being like the first one through. If you were talking to a founder who had the opportunity to go to Techstars or go to a potential accelerator / incubator with a lot of promise, that's the first one of it, which one would you recommend?
I think Techstars is such a good brand now and has such a strong network that I would go through Techstars personally. And I think there's a lot of accelerators or incubators out there that maybe promise more than they can deliver. And so there's like always that sort of trap if that happens. But so I recommend Techstars to everyone. I invested personally in a couple of programs that came through Minnesota through that accelerator, and one of the founders was somebody I invested in before Techstars, and I encouraged him, hey, why don't you invest in the Techstars accelerator? And this was last summer, and he had a great experience, and so I think based on that, I think it's probably still worth doing Techstars.
Are you an LP in the Techstars fund that's invested in inKind?
I am they have 4 funds, so Bullet Time 1, Bullet Time 2, which is what David Cohen started. Then there was Techstars Ventures, which invested in us. And then there's the second Techstars Ventures fund. I'm in 1, 2, and 4. And I think our investment in inKind is actually from 3. So I don't think I am.
And I wonder, I just don't even know, like, what does that mean? My head kind of just exploded with the circular logic thinking about it. Like, if that was the case, is there any problem with that? Is there any, like, upside potential for you for that? Like, I'm just trying to think through, like, what that would even mean.
Techstars is such a big fund that, their biggest investors are institutions, right? The little guys like me make up a tiny percentage of their fund. But I'd say Firebrand was an interesting one because John invested in inKind, and he was such a good investor that I asked him, can I invest in your fund? Because not only do I think you pick great companies, obviously you picked us, just kidding. I think that he helps the companies that he works with. He really opens up his network. It comes back to him being smaller, so he just cares a lot and puts a lot of attention to every company. So I asked him, can I be an LP in your fund? And he said, you'd be the only LP outside of Kansas City. I was like, awesome. So I am the only LP outside of Kansas City.
What about John specifically? He's been on the podcast. I think he's how we got connected to you. We think he's awesome too, but specifically having dealt with him in a business setting, what makes John so magical?
I think when, with an investor, you're always sort of courting and, before the investor commits, and then you as a company or a founder also want to make sure that you're going to connect with the investor in the long term. And I remember I went out to Kansas City and had dinner with John, and the types of questions that he asked me made me really understand that he would be a good culture fit for us, and also that he cared a lot about us as founders. So, how many hours of sleep do you get? Are you able to exercise? Like things that you don't normally hear from an investor. And he's not looking for 4 hours of sleep and no, I'm just at my desk all day. He's like, this is a marathon, which it is. So I need to make sure that the people I'm investing in, can be around for the long term. And I think that's different than a lot of venture investors. We're fortunate in the company's doing well, and we have a choice of kind of who we want to invest. There's a lot of war stories, of people who take venture and then are just driven to growth at all costs, and it hurts them personally. It also hurts the culture of the business, and I think John's probably the opposite.
Do you think he pulled that from his time at Techstars?
I do, yeah. I think that Techstars has this saying called "give first," and they actually do that. That's sort of what they believe in, and in the long run, things will go really well.
I'm interested to hear, you've clearly made the intentional decision to take on investment, even though you are an investor in different funds and things like that. Why not bootstrap inKind?
Yeah, we sort of do bootstrap inKind. We've raised a little over $2 million, which is not that much money in the grand scheme of things. But what we really look for are people who can be really helpful as investors, who obviously aren't going to quit their day jobs or come work for us full time. So we leverage our investor base probably more than other companies do, just because I know as an angel investor, when I invest in something, I want to reach out and help. But the only way that I know how to help is if I'm informed by the company. So we send out really detailed, honest updates around what's going well in the company, what's not going well to our investors on a regular basis. And then I get awesome feedback. I'll get 5 emails back. I'll jump on calls with people who've built substantial businesses, who've seen the same maybe issue that we're dealing with. And an investor, the more time they spend with you, so they give you money, so they're obviously bought in, but then as they spend time with you, they become even more bought in and they're even more helpful, right? And that's really, for us, we take investment from people who we get along with, who we really want to help us build the business. Jonathan, my best friend, he was our first investor, and he's on our board. He probably does 15 hours a week of work for us for free.
Is that this Jonathan?
Yeah, that's this Jonathan.
Okay. Jonathan is joining us here in the conference room. I was like, wait, same Jonathan?
For free. We can't afford him. He has a big company, that, but he puts time into us because I think of the relationships that we have with our investors.
So I think this would be a good time to kind of transition into our next segment, which is, how did you start liking wine so much?
So I was in college, and I went to France, and I don't speak any French, but I went to a restaurant. I think it was called Taillevaux. Well, any French listeners are probably, that's totally wrong. But I had a 1975 Chateau Yquem, which was a dessert wine, a Sauterne. And it was the first wine I had, and I was like, wow, this is what wine can taste like. And after that, I just started trying more and more wine. Growing up, we didn't have any alcohol in the house, like none. Now, thankfully, my parents drink quite a bit of wine with me. But yeah, I just developed off that particular glass. I can remember it. I have a bottle now. I haven't opened it. And then it's been fun. Some people play golf, right? I don't play golf. So what I do though is I hang out with people who are in the industry or investors, and we drink wine together. We have a house here. Our inKind office is a house. And part of the reason for that is because I wanted a kitchen. So when John Fine comes into town, we cook dinner together, we drink wine together, and it creates that sort of culture.
It's very cool.
The wine culture, I'm an outsider into this wine culture, and you guys are much closer to it than I am. So my perspective is that there is so many types of wines, and it's almost like an art collector type space where there are all kinds of artists, and when someone talks about it, it's kind of like, do you recognize them? And then if you don't, how much do you bullshit to pretend like you do? So what type of like wine culturists are you guys? Are you like trying to become a sommelier? Do you like love to try to get down on some of the specific notes of what's in this wine?
So maybe I'll answer first. I think the more you learn about wine, the more you realize you don't know much about wine. Like every day I'm learning something new. And that's to me what I like. I like hanging out with people who know a little bit more about wine than me, and they can teach me something, about the bottle that we're drinking. Or if I'm drinking wine with people who know less than wine about me, I try to teach them something about the wine we're drinking. This wine here is 3 grapes. I don't even know what they are, from this tiny, tiny producer just south of Sydney. Like none of us probably have had this wine before. And so it's special to be able to share that experience with people. In terms of price, there's obviously a bottle of wine that's $500 probably tastes better than a bottle of wine that's $10.
I love the idea of a new bottle of wine as a shared experience with somebody. I hadn't thought about it that way.
I've never really got into the tasting notes. By the way, this is the first question you've ever asked me on the podcast, and it's about wine. I think that's like you pretty much said my answer, which is like wine is about the people, not about the product. And it's just a centerpiece for the conversation. And the nice part about it is it makes you giggly and happy, So you're never having a bad conversation over wine. Although sometimes it can be a little emotional.
So you transitioned into this Equity Eats platform, and you guys crowdfunded that first restaurant. At some point, you shifted into inKind. So talk to us about that transition and where you are today.
Yeah, it took a little bit of time to, we crowdfunded some restaurants, and then to see if those restaurants were going to do well or not. They started we could see the return as an investment, as an asset class. And I had actually invested personally in about 30 restaurants before Equity Eats. And, they were some of them were doing really well. And after a little while, so I would say a year and a half, we started to realize that the investments in restaurants, so, through the crowdfunding platform or even personally, as an asset class, were not that great, right? Like a couple of bars that have killed it but most of the 30 restaurants, probably like 3 are great investments, So we had a friend who's a chef who actually was working in our restaurant as doing a pop-up there. And he said, Johann, will you invest in my next restaurant? And I looked again back at the restaurants that we had done, and I looked at the crowdfunding platform, and I was kind of like, you know what? I don't really want to, like I want to help you because, I love you and you're a great chef and you're going to have a great product, but is there a better way to do it? And so what we did was he found a second generation space and he needed money to open, and he was opening in 30 days. So I said, Kevin, why don't I just buy credit in your restaurant? I won't take an ownership perspective piece. You don't have to pay me back. I'll buy credit, and I'll buy it at a discount, and then I'll turn around and sell that credit to people and pay myself back. And that way, you don't have to have any other partners in the restaurant. It's just going to be you and Carly, who's the operational partner. And that's what the first deal we did under inKind, and it just went really, really, really well. We took the credit. I didn't know that many people to sell the credit to, so I had to sell it in high dollar amounts.
And you took that marketing on yourself. You weren't asking him like go out and market this and sell the stock that I like the credit that I bought. You're doing it on your own. Yeah. We had gotten good at like how to market things through crowdfunding, so we were going to be better than he was. But then also we had people that had eaten at his
eaten his food at my restaurant. So I knew those people. So I called them, and I was like, hey, you loved Kevin's food. Why don't you buy $1,000, we called them gift cards at the time, and I'll give you a $300 bonus, right? Or buy a $2,500 gift card and I'll give you a $1,000 bonus. People were like, that's kind of cool. Yeah, I'm going to eventually go, I like his food when he opens. And we were able to sell all the credit. And we actually sold the credit in about 60 days. And so I looked at it from a restaurant investment perspective, and I was like, whoa, I made my money back and a profit on this deal in 60 days. And Kevin looked at it, and he was like, I just have to service people coming and eating. And 2.5 years later, only like 65 or 70% of the credit that we sold has even been used. So he looked at it, and the cost of capital, was nothing.
How long does that credit persist? How long do you have to hold that as like essentially kind of like a liability for them to come back and use it versus saying like, okay, this is just written off now?
Yeah, so it falls under gift card law, and usually in most states, gift cards can't expire the face value. So if you paid $1,000 for, we call them house accounts now, so if you bought a $1,000 house account and it gave you a $300 bonus, the $300 bonus expires in 3 years, but the original $1,000 you paid never expires.
How much did you buy at a discount? Like what discount did you get that at? Like 50%, 60%? Like where was it?
Yeah, it's almost always a 50% discount.
Okay. What are gross margins in the restaurant industry?
That's a great question. Gross margins are usually, cost of food is usually about 30%. So if you're selling a salad on your menu for $10, that salad's costing you about $3 to produce. Cocktails usually, cost 10%, 12%, something like that. So you have much, much higher margins. Steak, for example, is probably your lowest margin item. And, there you're probably making 60% gross margin. So gross margins in restaurants are very high, very high. Net profit of restaurants are not so great. A well-performing restaurant probably has a 10% net, but a 70% gross margin.
What are the biggest hindrances toward, so it's a revenue generating game, right? And space is your kind of biggest constraint on how many plates you can serve a night.
Yep.
So is this helping restaurants be fuller earlier on? Is that like a benefit here?
Yeah, we just did this study. It was the first time we've done it, where we were able to get data from a restaurant that had people who were frequenting the restaurant and then who bought house accounts in the restaurant. And then we were able to see their frequency and their spend after they bought a house account. So prior to that, I could compare check sizes for somebody using a house account to like a credit card statement. But the people who are buying house accounts are better guests anyway, so they're going to spend more money per visit anyway, so it's not a really great comparison. But in this example, I was able to identify 55 people who had been in the restaurant before buying a house account and then after. And their spend per visit went up by 80% once they bought a house account. And we were able to look at, so that cohort of 55 people, and we assigned an annual value. So they come in once a month and they spend $10 a visit, so they're worth $120, right? And the total value of that 55 people was $31,000. Once they bought house accounts, their total value was $120,000 a year. So people come in way more frequently and spend a lot more.
Is that almost like the psychological effect of why casinos use chips, because it's like not real money?
That's exactly the example in my mind that I use. Yeah, it's chips in a casino. It's credit, it's on an app, you've already prepaid for it. So rather than getting a glass of wine, you get a bottle of wine, right? You get extra cocktails. And then there's also this kind of, somebody called it the why not factor, which is, hey, we're going to dinner tonight. Where should we go? Oh, we might as well go to this restaurant. We have credit in it, right? And this happens all the time. So frequency increases a lot.
When I was growing up, a lot of my friends belonged to country clubs. I didn't, thanks mom and dad, but I got to go with them all the time because they had a house account effectively where they're like, dude, we have to spend $500. So we would just go and order everything, and we usually overdraft the account. But sour punch straws, chicken fingers, all the good stuff, right? So I feel like that makes a lot of sense from a luxury perspective when you have a large ticket item. So I'm curious what your breakdown is in customers, because I saw on your website that it's $750 is the average amount of inKind user, like single transaction. And you have 4 James Beard restaurants or something like that?
Yeah.
So is this like all luxury facing, or will this work in smaller markets with smaller numbers?
Yeah, so we start the house accounts at usually 10 times the per person check average. So if we have a great breakfast place in Utah that has 5 locations that we funded, and it's probably a $10 per person check average. So we'd actually start the house accounts there at $100, and it would have like 100 gets you, I don't know, 120, 250 gets you something, and 500 gets you something. So the analysis that we do ahead of time is we go, how many house accounts can we sell in this particular restaurant? And then how do we price the house accounts? And that's how much funding we can provide upfront to the restaurant. So usually if it's a lower check average, the funding amount is lower. We can still work with the restaurants, but yeah, but you can't provide as much capital. The other aspect is you can always increase the bonus amount that you're giving the customer to make it more attractive. So we just did a test with a coffee shop in Brisbane, Australia, where he was offering high dollar house accounts. I think they started at $250, but he's giving them like a $200 bonus. So, and they were selling a lot. And he's really happy because coffee is really high margin, right? And he's on the same street as 3 other coffee shops. So he's like, I'm going to lock in my customers. They're going to pay $450 and they're going to come in every day.
Right.
So that is a model we're still figuring out, like fast casual. I think the answer is going to be to increase the bonus amount, and that way we can keep the tiers higher and lock in the customers. But it means that we'll have to buy the credit at a higher discount than 50%.
What's your current margin look like? Because it sounds like you could still just play with your margin to make it whatever you want it to be with the bonuses. Is that the biggest cost driver for you guys?
Yeah, buying the credit is the biggest cost driver. Yeah, and then we incentivize staff in the restaurant if they talk to people about it. So when you have regular customers who come in and you say, oh, hey, we have this awesome new loyalty program, check it out. And if somebody buys a house account based on them and their referral, we'll pay the staff or sometimes the manager, it depends on the restaurant.
So it's not always the opening of the restaurant when they want this funding. It can be at any point that they want to take on additional funding to help with operations.
Yeah, we work best with restaurants that are already existing, that are either opening second locations or are building a patio, because we're able to underwrite better. We can kind of know, okay, we can sell this number of house accounts in those types of restaurants. If it's a brand new restaurant opening and the group doesn't have another restaurant for us to underwrite against, usually we'll offer like $25,000 or something like that in funding. We provide it 30 days before they open, and then we tell them, hey, if this is going well and if we're selling a lot of house accounts, we're totally happy to give you more funding 30 days later, 60 days later.
Do you have a lot of customers that are restaurant groups, or is it mostly individual restaurants?
Ooh, in terms of customers, so we financed about 150 restaurants so far. And I would say probably from like number of restaurants perspective, we probably have more groups than individual restaurants. It's easier for us to underwrite a group, and it's also easier for us to work with a group. So, our biggest funding amount, I think, is about $800,000 to date. And our average funding per restaurant is about $60,000, I think $58,000, something like that. So if it's a group with 10 restaurants, we can provide $600,000. And for us, it's easier to provide that. It's also easier to sell the credit because you can use the credit at any of the restaurants in the group.
Have you have a restaurant that you funded where your assumptions just proved totally wrong?
Yeah, definitely. We funded one restaurant where we were like, this is great, a lot of customers, and they're a franchise. And what happened was the franchisor said, wait a minute, you can't sell house accounts in this restaurant. And the owner of the franchise pushed back, and he's like, no, this is great for the business. And the franchisor was an overseas company, and they were like, nope, you can't do that anymore. So we ended up not being able to sell house accounts in that restaurant. But what happens generally is we have a really good relationship with the owner or the people that we're funding. And so we try to work through whatever, So we had one case where in my opinion, we took too much credit. So the funding, it sold really, really quickly. We sold out of credit in 3 weeks. And in their margins were a little bit lower than restaurant margins would normally be. And so we actually gave a rebate back to the company. We said, look, we made enough money on this, and we want this to be even better for you. They didn't ask for it, and we gave that back to them.
Yeah, I was going to ask where that kind of breaks down. Like, can you sell out so quickly, and then people come in with such velocity that it just breaks the restaurant's ability to actually fulfill that credit obligation?
No, because we only sell high dollar house accounts. So if we sold, pay 50 and get 100 in credit, we'd fill the restaurant seats with people using credit, which would be detrimental to the restaurant. So we really designed this out of, we're restaurant owners. We want to have a super restaurant friendly platform that in the long run makes sense. And something like 80% of the restaurants that we've worked with, we've funded a second or third time, right? So it's really worked well for those restaurants.
What's the ideal percentage of customers in a given week, month, year, whatever, that come in and pay using credit versus come in and pay using full cash?
I'll give you two sort of numbers. The restaurant where we were able to look at their people who were buying in the store before buying house accounts. So there was 55 people who bought house accounts. The database that they had was 5,500 people who were part of their loyalty program. So those were pretty regular customers, but of those 5,500 people, 55 of them bought house accounts. So it's a very, very small number of people. So if we're selling $100,000 in credit to a restaurant and we're selling it $1,000 at a time, that's only 100 people. So on any given day, more than likely no one's using credit in the restaurant. And that makes it very healthy for the restaurant. So the second answer is the most cash that we'll give a restaurant is 4% of their expected annual turnover or their actual revenue if they've already been open.
How'd you get to that number?
So so it's a 50% discount. So we end up taking 8% of the revenue in credit. And we know that 40% of the credit gets used in the first year on average. So we're like, okay, so that means 3.5% of your revenue is coming through credit redemptions and not through cash. You can still operate and have a successful business. And the second year, it'll be like 20% is redeemed. So it comes way down. So in that first year, we just really don't want to have any kind of a cash strain on the business.
Do tips get included in the house account or are they separate?
You can't pay the tip using your credit that you bought, but on our app, with the credit card that you use to buy the house account, it gets attached to your profile. And so when you pay, you can just charge that credit card for tip. And the reason is, when a restaurant calculates the cost of inKind, they go, okay, they're buying $100,000 in credit. If all 100,000 of that gets used, it'll cost me $30,000, right, in food. If they then had to pay tip on top, there's another $20,000 in actual costs that they'd have to pull out of their pocket. It becomes more expensive for the restaurant. And the customers, this has been really interesting. We looked at one of our James Beard Award winners. We looked at their tips. The average tip that a customer left when paying with the house account was 27%. And yeah, that's 50% higher than, what you normally see in a restaurant. And what that's done is in that restaurant, it's created this great sense of community around house account holders. So servers, when they know house account holders come in,
They're regular.
They provide them with an even better service experience, which leads to a higher tip. And so it's like this virtuous circle, of people getting better service.
It also incentivizes them to use the bonus program you're talking about where servers can make a percentage on selling house accounts, right?
Yeah, absolutely. And the servers know that they don't probably know that the guest is going to spend 80% more, but they know the guest spends more. And the server's tip is based on the month that they spend. And because we designed it so that, you pay the full price in credit, you're going to tip on the full price. So you don't tip on a discounted amount, which is the problem with a lot of discounts. If you come into the restaurant and I give you a 50% discount, more than likely you'll tip on the discounted amount. But with our program, people are tipping on the full amount.
How long have you been owning restaurants?
So we opened Prequel in DC for 5 years ago now.
So restaurants are notoriously cyclical. When we have kind of crashes in the macroeconomic space, there generally is a decrease in people going out to eat. Do you think that same thing holds for inKind? If we had a crash, like an economic crash or recession, do you think that inKind would suffer in line with the restaurant industry?
I actually think that if we had an economic crash, inKind would do better. So I was talking to a restaurant group in Melbourne, Australia. And in Melbourne, property values apparently have been coming down. And he believes that the economy is slowing down. And so he wants to use inKind because he said we can lock in customer spend in our restaurant group, right? And customers, as the economy does worse, become more sort of selective about where they want to spend.
Cash conscious.
Yeah, cash conscious. And so they're more likely to buy something that gives them a bonus, and continue going to those restaurants. So I actually think, and then the other part of that is as a financing option for restaurants, we're competing with private investors, or we're competing with banks, I guess, or cash advances, things like that. The harder those become to get as the economy comes down, the sort of the easier it is for us.
Do you see people using this to manufacture credit card spend? Like would I open up a credit card and then use that credit card to buy a house account because I'm going to get a bonus, but then I'm also getting a bunch of points back on my credit card because I just bought $1,000 in house account.
It's a great idea. Yeah.
You really should go to like Flyer Talk in a couple of the forums and post it.
Do any of the restaurants have like secret menus for house accounts?
So what we do is we promise the house account holders their bonus. That's what they're promised. That's what they're buying into. But definitely the restaurants do special things for their house account holders.
Yeah.
We just had a restaurant. I went to dinner there 2 nights ago. The Brewers Table here in Austin. I think Eater named them one of the best new restaurants. Great restaurant. The Brewers Table did a special dinner last week for their house account holders, invited them in, gave them some new menu items they're trying out, right? So the idea is you get these house account holders and they're great regular customers. How do you leverage them to bring in new customers and build a better community? That's, I think, the value of inKind, like very straightforward, is really, really low cost financing, right? That's what we are. But what we've learned sort of from looking at the restaurants that we finance is really like the loyalty side of it becomes very valuable. And then bringing in new customers by having your best customers refer them to come in is kind of the third value.
It seems like there's a weird moment in time where loyalty in general seems to be at like an all-time low, but at the same time, I almost thirst for more of that. And so when I have like a good excuse to have that, like I have loyalty to my barber. He's actually been on the show. I have loyalty to my barber, but just about nothing else. Like I had a gym that I loved, my co-working space I feel loyalty to with community. And I think this like really taps into that well. There's a Tim Ferriss episode, and I don't listen to a lot of Tim Ferriss anymore. I don't know why I felt like I had to preface that way. Where he interviewed Nick Kokonis, the restaurateur. You heard him? He built a product that was like sort of like loyalty, but it was about pre-selling seats in the restaurant through an online software so they could optimize actual like utilization of their time and like their table availability. And I feel like something like that would dovetail here well too.
Yeah, my background's in tech, right? And so we test a lot of technology products in our restaurant in DC, and then we can either integrate them into the inKind sort of platform, or we just make recommendations to the restaurants we're working with, because restaurateurs don't have time to analyze every point of sale and every new reservation system, but we do. So we do a lot of that and then just make recommendations. I just met with the entrepreneur in DC, has a great ordering system. QR code doesn't require an app. You can order more food. It works really well with surge times in restaurants. And so now we're recommending him to a lot of restaurants we work with, that we see that same problem. For 2 hours a day on Wednesday, Thursday, and Friday doing happy hour, they're really, really busy. They can't staff up. So this augments, having physical staff in the restaurant.
Have you ever failed to sell out on the credit?
We have ways of basically making sure that we'll eventually sell the credit. If we don't, or if the restaurant's not, participating, then we actually sell back credit to the restaurant at the cost that we paid for it. So nobody likes to do that, but the restaurant doesn't want to buy credit back in their restaurant. But no, of the 150 restaurants that we've done, we've lost money probably on 3, where they went out of business while we still held credit in them. And so we've just sort of improved underwriting. In all 3 of those examples, we didn't check for this. Now we do. They were behind on sales tax, and so the government shut them down. But so now our underwriting is better.
Is this kind of a land grab? Like, why can't someone else do this?
Yeah, I guess you could. No one else is doing it. I think we've learned a lot about underwriting. We were really good at selling the credit, and now we've sold. We have thousands of house account holders, and that is actually really attractive. So if you're a restaurant in Washington, D.C., which is where we have the most, and we've helped finance you, basically we can go to our thousands of people in D.C. who bought house accounts, and other businesses, and give them $20 in credit to come check out your restaurant. We don't try to sell them a house account. We just say, hey, go check out this restaurant, and we think you're going to love it. They go into the restaurant. If they have a great experience, then we'll try to sell them a house account. But because of the user base that we have, we've now sort of become a little bit more defensible. I'd say other than that, the only reason somebody wouldn't do this is because generally speaking, there's a lot of learning in how to fund restaurants. And if you don't know that, you'll learn it. You'll just spend a couple $1 million.
It seems like the natural like tech evolution. A lot of people would be like, one uniform house account, buy into the house account. But I feel like that might actually chip away at the foundation of what you built here. Have you guys thought about that?
Yeah, I was meeting with some potential investors in the Valley, and that's what they were like. One unified house account.
Class pass.
That's all we want.
Class pass for restaurants.
That's what we want. Yep. I think you're exactly right. The loyalty part of what we're doing is we're getting people to go back and spend more money in a particular restaurant, right? If suddenly you can spend your money at any restaurant, you're not going to get that behavior. You're just going to get a behavior of customers who essentially are getting a discount for going out and eating, right? And that's not a behavior we want. Maybe eventually there are better ways to allow people. So what restaurants really want are new customers trying them out, right? And then for the regular customers to have a great experience and spend more money. So the nice thing about being able to buy a universal house account is it would bring new customers into a restaurant. But I think there are other ways that we can solve that problem that doesn't diminish the core loyalty value.
I would assume it's like a group of friends. If I have a house account, I'm more likely to recommend that restaurant to my group of friends who hasn't seen it, and then like sign for the check and have them Venmo me or something. And that's accomplishing the same thing.
Absolutely. Or in a lot of restaurants, they'll offer you a referral. So, hey, you can send $10 to any friend that you think would like the restaurant. And when they come in, they'll add $10 to your house account, or book a private event and we'll give you 3% back into your house account. So those kinds of things like basically help build loyalty, bring in new customers, and then also increase revenue because restaurants love private events as an example.
Seems to make a lot of sense to me from a restaurant side of thing, but from a user side of thing, I kind of have a question around the expansion model because yeah, it makes a lot of sense. You guys can go to pretty much anybody in DC and be like, look, we have this backlog of users that are in DC. But if you came to Columbus, for example, I don't think you have anything there. I could be wrong.
I have to look. We might have one, but generally speaking, probably no.
Yeah. So you can't use that same pitch to all the restaurants in Columbus. So what is your idea for expanding? Because you have to go geography by geography. You don't have that class pass model.
Yeah. So if we were going to a restaurant in Columbus and they asked us for financing, it would probably be an easy sell in that they'd look at our cost of financing and they'd go, okay, well, this is way cheaper than a loan. This is long-term cheaper than equity, right? So they probably would sign up because they want the funding, right? And at a very low cost. We won't be able to send in users from other restaurants or from other businesses because we don't have them. But just from a funding perspective, the restaurant in Columbus would probably want to work with us. We are really good at selling the house accounts, like at marketing them, and we take on all of that.
What makes you so good at that, I guess is my question.
Done it for so many restaurants now. So, wording on flyers, or we do things with like conversational text messaging, which, I invested in an AI company we're using a lot of their technology around. So it's things that an individual restaurant, my opinion is that every restaurant should sell house accounts, whether they're using inKind or not. Like they should sell house accounts. You should offer your guests a $1,000 gift card and give them $1,300 in credit. Like this is a good thing. It will help your business. We just make it a lot easier to manage that process, and then using technology to sell the house accounts, and then also to leverage the community of house account holders in your particular restaurant to drive in more traffic.
This hasn't been explicitly said, but I think if I'm reading between the lines, you guys have a mobile app that manages the house account transactions and payments and stuff, right?
Yeah.
So that's its own proprietary technology that's involved with inKind as business.
Yeah, absolutely. We have a manager app. We do some cool things with data. So, hospitality ultimately is loyalty, like comes through hospitality. So when you go into a place and they know your name, as an example, you're more likely to come back, right? Because you had a good experience, or they know what kind of wine you like or whatever. So we have that information. So when somebody buys a house account, they can actually, in the app, they can give the restaurant whatever information they want. And then we put Bluetooth beacons in the restaurant. Somebody walks in on the manager's phone, their picture pops up, what their preferences on wine, their name. Manager goes over to the table and says, hey, how's it going? Jeff, thanks so much for coming in. Suddenly Jeff has had a great experience. So, you can't do that with a physical gift card. So we have a lot of technology in the back end that comes along with what we do just to make it an even better experience.
What doesn't inKind do well? Like everything, it sounds awesome. It sounds so thoughtful and thought out, but you've only raised $2.2 million. So like there has to be some limitation somewhere, or you're just minting money. I'm not sure, but like what doesn't inKind do well right now?
Yeah, I think it probably depends who you ask. If you asked a venture investor, they would say inKind isn't aggressive enough on our growth. If you ask me, I think the company will grow to a very, very large size, and will do it in a manner that actually like maintains customer-centric, sort of slow growth, great culture for the business. Everyone's happy. We're like a family. And so I think we do that well, but a lot of people would probably say, no, you guys should be growing faster. Our actual revenue in January was probably like $400,000 in the month. if we grow in the way that we expect, probably by the middle of the year, we'll get $1 million a month. Like it's a pretty good business. It's growing well. We've got a great partnership in Australia. We have a lot of other people reaching out to us to partner with us. But we're super happy, and we want to grow, but we want to grow in a way that really makes sense. And that's probably what we maybe don't do well. I'm not a super aggressive founder. I really believe let's work the best that we can on the product. Let's make this really customer centric. If the restaurants love it, they'll continue to use us. We don't have any salespeople, as an example. Every single restaurant that we worked with has been a referral from a restaurant that's worked with us and has been a repeat customer of ours because it's worked so well. So as we move into sort of our next stage, which is more on the growth side, we'll start to hire salespeople.
What is your team size right now? Including
the 3 people in Australia, I think we're at 11.
Okay.
We have a developer in Mexico and one in California.
Are you guys going to raise soon?
No. We would always raise money if there was the right partner that could add a lot of value and that we really wanted to bring on the journey with us on the equity side. On the debt side, I mentioned we just brought in a new CFO. Part of what he's doing is going out to institutional debt investors. So the money that we provide to the restaurants, we borrow. And then we pay back those investors as we sell the house accounts. And that's gotten to a point where it's big enough now where we can't finance it ourselves or with our existing investors' debt capital. So now we're looking for larger debt partners.
What do you guys pay on a cost of capital side of things on debt? Because you have a lot of accounts.
We pay a lot.
Yeah, 11%, 12%?
More.
Wow, that's sub junk.
But it's only because everyone who is a debt investor is also an equity investor in the business. Basically, we go out to our existing investors and we say, hey, we need another $1 million to fund this month's projects or this week's projects and last week's. And then who wants in? So we have a waiting list of people who want in. And depending on how quickly we can sell the credit, the investors make more money. So last year, it's not a fixed return, but I think last year our debt investors made about 17.5% on their money.
So you guys just cash flowing like crazy?
It's that knob between growth and profitability. So before we brought on our CFO, who's expensive, it was profitable. Now, we're spending more on growth, more development. So this month probably won't be profitable, but it's kind of nice to be able to turn that dial.
Yeah.
What are we not asking?
Where can you buy a house account?
That's how we always end the interview. I will get to there. Before we do that, talk to me about being in Austin. What's that mean to you guys?
Yeah, so we moved to Austin. Great city. There's no income tax here. There's no state income tax. And DC is a lot more expensive in terms of hiring people and having an office and all of that. So I think Austin we really like. It's been a little harder in Austin to find more senior talent. Derek, there were at least 4 or 5 startups in Austin that were competing for him. Senior developers, we're having a little bit harder time finding, but I think that's probably the downside of Austin. But otherwise, yeah, we really, really like Austin.
Awesome. Well, thank you so much for your time here. This has been fascinating to me. And Eric threw a lot of numbers questions that taught me a lot. If people want to know more about you or inKind or check out a house account after the show, where should they go?
Go to inKind.com. And my email is Johann, Johann, at inKind. Yeah, love chatting with everyone, especially we love food and we can have a bottle of wine together. Perfect.
Yeah, cheers.
He's not joking about that one. All right, Jay, we just spoke with Johann. That was a fun interview, something a little different, a little new industry for us. Have you ever owned a restaurant?
I've never owned a restaurant, and I don't really plan to own a restaurant, but that was one of the most compelling arguments and conversations for owning a restaurant.
Maybe we should bring on someone who has owned a restaurant.
Yeah, we thought it'd be good to get some additional insight here for this interview with Johann. So we brought in Kevin Tien, the executive chef at Himitsu in Washington, D.C., as well as Hot Lola's Sandwiches in Arlington, Virginia. Kevin was nominated as a Rising Star Chef of the Year by the James Beard Foundation and has used inKind now twice to open those 2 restaurants. We thought it'd be a good addition here to talk to an inKind user and customer to get their perspective. So please enjoy this short conversation with Kevin. Kevin, welcome to the show.
Hey, thanks for having me.
We interviewed Johann of inKind, and I know you've interacted with him with Hot Lola's, but it sounds like you also launched a second restaurant with inKind?
Yes.
Can you talk to me about how you met the inKind team?
So I met Johann, Andy, and Matt at a space they had here in DC called Prequel. And at the time, they had rotating chefs go through and work on a restaurant concept. But at the time, I wanted to do a small temporary pop-up over a weekend. They had no idea who I was. I just told them a couple places where I worked. And they're like, you know what, let's try something different. And they took a chance on someone who pretty much walked in off the street. It was a wildly successful pop-up. And I think through them watching how I work and with them and with the guests and with my staff, they saw something there and they felt like they wanted to help me invest in a new project eventually whenever I opened up Himitsu and now Hot Lola's.
Why did you want to work with inKind? What was it about what they were doing that you saw could be useful for Himitsu and then now Hot Lola's?
I think the biggest thing for me was they took a chance on me, all right? They asked me, a few basic questions on my experience and how I see the operations and the workflow and everything going. But other than that, they let me be very self-managed. And if I needed any help, they were always there to help give me guidance and advice on what can help make our business successful. So I literally text them all the time, all hours of the day, from 8 in the morning to 1 in the morning to the middle of the day. Even call, they always pick up the phone immediately. So outside of just being a capital partner, they're also good business partners. Now we're really good friends. They're always there for you, even after they help with your initial investment.
If it wasn't for inKind and the capital that they were able to help bring to the table, what would you have done?
I probably would have sold my skill set on the streets. Started doing a lot of people do pop-up dinners all the time. But pop-up dinners can get expensive from finding a location, and then you're putting a lot of money up front for all the staff and then sourcing the food. And at the end of the day, it takes forever to kind of make the amount of money you need to open up your own spot. With inKind, what they did was they gave us a lot of the money up front, but on the back end they sell restaurant credit, which is fine by me because all day food costs is a cost that I can control. But at the same time, if I'm putting out a good product and providing a good service, I'm building brand loyalty. Not only are they giving you capital, but they're giving you this big customer base to start your business off with. And then all the credits that you sell to your restaurant is used over time, so it's not like everyone's redeeming it upfront.
Did you have an audience or people who wanted to be your customer already? How did inKind sell credits to a restaurant that didn't yet exist?
So I was actually their first person they ever invested in. Up until that point, I was pretty quiet about where I worked, but I worked for a lot of nicer, higher-end restaurants in DC that have a really good reputation. But I wasn't the head chef anywhere. I was a sous chef here, a line cook here. But it started off slow. I'd say our first week, we opened on the same day as a very another big restaurant opening in DC. So a lot of it was word of mouth, us being a big part of our community, talking to the neighbors, talking to everyone in the industry. And then after month 3, we got kind of I call it our big break. Tom Seatsman of the Washington Post came by, wrote a review on us. It was very, very nice. And after that, things getting busier, and it's all word of mouth. It's always putting out a good product. It's always asking questions on how we think the operation should run and always asking for a lot of feedback.
Can you talk to me about customers who come into your restaurants who have a house account? How are they different than customers who may be coming to your restaurant for the first time?
I think everybody here gets excellent service and excellent treatment. But one thing that inKind does is we have this little module. So as soon as a house account comes in, all the management and staff gets a notification. It says, this person has arrived at Himitsu. So we know, hey, these guys are kind of our early adopters, and they believed in us in the beginning. They gave us money when we were nothing. So, we say, hey, good to see you again. We tell them, thank you so much for continuing to support us. Well, we tell everybody this, they always get a little bit extra because they were here before we were anything.
Do they seem to have more of a connection to the restaurant than other customers do?
Yeah, all the time. And I guess the funny thing is we actually had a house account come in the other day. And every time they come in every couple months and they see how much the menu has changed, or they see the restaurants change. And it's really funny because they're oh man, remember back in the day you didn't have this and we were operating like this. And it's fun for them to see us grow into what we are now. And then I think they're really excited to see how we grow from here as well. Kind of watching your kids grow up and then leave, go to college.
Yeah. As the restaurant owner, you mentioned that food cost is something that you can control. Do you have any worries or fear with the amount of credits that you could have out at any given time?
No, because I think a lot of the people who like get the credit, they also like realize that we're a business and we have to like obviously like pay all our costs. So like actually a month ago, we had a customer for the first time. They're like, "Oh, we actually want to use our credit that we bought when you guys first opened." And I was like, "But you've been here a million times. We've been open for 2.5 years." They're like, "Yeah, we know, but you just opened and you need to make money, so we wanted to like pay for our meal." So from a customer standpoint, they understand as well that we're a new business, and a lot of them hold off on using their credit.
That's wild. Is there anything else about inKind that I'm not asking that I should be asking you?
I think if anybody wants to partner with them, I would highly, highly recommend it. When I first met them, I didn't know them, but like I said, they took a chance in me, and they're always in like an open book and a good resource for information, and just like all around good people. You don't really find a lot of people that like want to give a business money and really don't want anything in return. They just want to see like your success, which is amazing.
Awesome. Kevin, if people want to check out your restaurants, where would they go? Where do they have to be?
You'd have to come see Himitsu in Washington, D.C., and they have to go to Hot Lola's in Arlington, Virginia. Both very different restaurants, but both very delicious.
All right, Eric. So now we've spoken with both Kevin and Johann of inKind. We have a lot of information here and a very unique business. We could start with the founder. We could start with the opportunity. Where do you want to start today?
Have you ever thought about creating a mock award called the Jay's Beer Award?
Jay's Beer or Jay's Beard Award?
Jay's Beard. Did I say that?
I don't know if you said beer or beard.
Jay's Beard Award would be a funny award. Jay's Beer Award would also be a funny award. And really, I mean, you have the authority to kind of give it out.
That's true. I have thought in the past about creating fake awards for all kinds of things. I had a mentor one time tell me that one of the best ways to get in front of somebody that you're trying to meet is to invent a fake award and then tell them that they won.
The thing about the Jay's Beard Award is that it plays off the idea of James Beard. So people will like have an instant heuristic there where they think it's either funny or like semi-serious.
You have a lot of legal experience, Eric. Doesn't that sound like it falls into the camp of consuming or confusing to the consumer, where I might be in some legal trouble?
Look, I'm not a lawyer, and we have our friends at Taft who could probably answer that question better for you. But what I will say is if you're not trying to make money from it, the chances of you getting in trouble are slim.
Well, Eric, because you're ducking my question, I'm going to say I would like to start by talking about Johann, the founder.
Oh, right. You asked me a question. I should have answered that.
Yes, that's how questions work.
All right. Well, yeah, let's start with Johann, the founder. That's a great idea, Jay.
Thank you. This was one of my favorite conversations on the background of a founder. One being because what a unique and awesome story being in the first batch of startups in Techstars' first accelerator, finding enough success with an exit that he could then invest in the first Techstars fund. You and I are both working through the venture deals course right now through the founder group with some of the Techstars team virtually. And it just strikes me that that must have been one of the best learning experiences for an entrepreneur that you could have ever asked for.
I would agree with that. One shadow I have on his background is that
when you say shadow, I have to say, wah.
We've said shadow so many times on this podcast, and you've never once said, wah.
It's got to start somewhere. Go on.
Okay, sorry. So one shadow I have on his background isn't about him, it's about the heuristics. I think that in venture, there's this idea of, oh, this person vetted them, or they have this on their resume, and maybe it's not venture, maybe it's just the world in general. If this person has Goldman Sachs on their resume, I'm more likely to hire them because I think that they know finance because they have this name. If they have Techstars on their resume, I'm more likely to believe that they know what they're talking about because they have this name. In a lot of cases, that's probably true, and that's why the heuristic stands. However, as soon as I heard that, I got skeptical during the interview. Not because I got excited during the interview. It was like, oh, there's this thing that I know means you should be great. And that immediately triggered in my own head, you're probably not great. And on top of all that, he gave me wine. So really, I was being buttered up to like him, you know? So like that in me like triggers instant skepticism. So as we went through the interview and as we asked tougher questions that he answered so succinctly and well, he really changed that skepticism back to my initial thoughts, which was, wow, this is an awesome founder.
And to give the listeners some even more behind the scenes, when we were reaching out to companies to speak with in Austin for South by Southwest, we reached out to Johann as one of the first founders. And we asked him some questions because we just couldn't find a lot of information online through our own diligence. And we wanted to make sure it was a good fit for the format of our show. So we asked him some questions and he gave us a lot of insight. And then before committing to be on the show, he asked us a bunch of questions about the podcast and our numbers, which was new to me. And I think, tying all these pieces of information together, what you see is a founder who's very thoughtful and intentional with how he spends his time and how he approaches the things he spends his time on.
I want to do a quick check against Care Alert. And I don't think you thought I was going to bring up Care Alert on this podcast, but in our deal memo for Care Alert, we discussed the idea that being an investor can make you a better entrepreneur or not. I think the jury was still out for me. For you, you seem to take more of a stance that being an investor didn't necessarily mean that you'd be a better entrepreneur. After talking with Johann, has that idea changed for you, knowing that he's an LP in 4 separate funds and he seems to have a knack for the investor side, or not?
Well, I don't remember precisely what I said in that Care Alert deal memo. I'm going to guess that I was saying I didn't believe that to be true unless the investor had previous entrepreneurial experience. And if that's not congruent with what I'm about to say, you'll have to tweet at me and let me know. But I think it stays the same in that it's more about the past entrepreneurial experience to me than the investment experience. So Johann obviously has past entrepreneurial experience, which married with investment experience, I think is great. I think that's extremely compelling. If it was just an investor who came into the world of venture, there's a lot of value there, but I don't think it's the same as having the experience of starting and running a company yourself through all of the stages that Johann has.
Any shadows pop out for you throughout this interview?
Well, as we get on Johann, the founder front, no. I think rock solid founder, somebody that I would love to get behind if and when the business makes sense. When we dig into the opportunity here, I'm a little vague still on the size of the market here and how well this scales. I love the business. I think it's an incredible business. I would love to run this business. I'd love to be a part of this business. Depending on what profile I'm looking for in my return, it may not be a business that I'm investing in, but we'll work through that here in the opportunity.
How big do you think the U.S. food and drink market is?
So I think from a pure food and drink size, it's probably very large.
Food and drink at restaurants, sorry.
Do you have that number? If I guess a number, will you tell me how close I am?
Yeah.
All right. I'm going to guess that it is $20 billion.
Okay, it's $800 billion.
Wow.
I would have said warmer or colder, but you were just so ice cold it wasn't even funny.
Well, here's the thing. Here's my question on this. And I guess as I'm talking through this, my question on this was from the house account standpoint. I love the concept of house accounts. And I think that it needs to be something that is not a class pass style. You can have a house account and use that at any restaurant you want. I think the magic is in having an account specifically with restaurants that you love. And I don't know how well that model scales. But given that you have communities all over the world and all over the country, and you could have like a city that has 2 house accounts in each of them and have those all over the country, it probably is a large enough level of scale that it makes sense.
Yeah, I think that big number is just a fun anchor. I don't think it's exactly what I would use to evaluate this opportunity. That being said, I did put some numbers together that I would use to think about this opportunity and start my continued due diligence. So he said that their average account size funds $60,000. There are 660,000 restaurants in the United States. That gives you about $40 billion of total funding if you just use their standard size, which could grow, could shrink. I don't know what the makeup of their 150 current restaurants is in comparison to the general US makeup in terms of check size. Another way to look at that is you take that $800 billion number and you say, okay, 8% of those sales are going to flow through inKind in a perfect world where they have everything because they have the 4% that they fund and then they're essentially selling 8% of sales, right? So that gets you to 64 billion, let's call it 60 billion. I don't think that applying 100% of restaurants to this model is the right move. So whenever we don't know what percentage to apply, I think there's two paths we can go down. We can do the Ed Thorpe 50-50, or we can do the Pareto principle, 20% makes up 80%. I'm more of a fan of Pareto, so we're going to go down to 20%.
I like 20% here because it feels like this is not your everyday restaurant type of model. They're going higher end, very specific restaurants.
So what that means is that you're going to be funding somewhere in the neighborhood of $8 billion to $12 billion. So let's look at their kind of unit economics real quick before we get to some sort of profitability potential. If you sell $100 worth of credit, $50 is going to go immediately back to the restaurant. $20 is going to be paid out in bonuses. And let's call it $10 is paid out, that might be a little high, to servers who incentivize things, to additional bonuses, to marketing, to all of these kind of admin stuff. That's going to leave you somewhere in the 20 to 30% margin range, probably closer to 20%. So if we apply that to our new number of 20%, now let's step back. We had the 40 billion, we have the 60 billion. We multiply those times 20% to get the total number of restaurants that might be inKind users. That's 8 billion to 12 billion, roughly. And then if we take that 20 to 30% margin, we're looking at something like 2 to 4 billion in profits. That's a huge opportunity.
That is a huge market as defined by Nick Solaro of Drive Capital, given that his metric was if you had 100% market share, and this isn't even 100% market share, but he said if you had 100% market share, could you capture $1 billion in profits in the United States?
Yeah, so probably some adjustments we can make on that. Obviously, one thing I'm not including is interest percentage. That will go down as this business model gets flushed out, but at 17.5% right now, that's going to cut a lot into that number, not counting in extreme growth. So that could be excessive amounts of headcount that has to be onboarded to hit sales of that number. But I think if we just kind of are thinking about this idea, the big takeaway is, wow, there's a lot of potential here.
Yeah, a lot of market. And if I'm going to play on the qualitative side here a little bit, in our conversation with Kevin, he noted quite a few things that Johann said, but it's always greater to get it from a customer. A couple things that stood out to me from that interview. He said, outside of good capital partners, they're really good business partners. He backed up their statements of restaurant credit being fine because those food costs are something that he can control. He says, I'm building brand loyalty. I think one of the underplayed aspects of this interview that to me was extremely compelling, that Johann kind of mentioned offhand, but Kevin mentioned in the interview as well, is the technology that underpins this, both from the mobile app that is the house account, but more so from the technology inside the restaurant that gives them a notification when a house account holder walks into the restaurant and allows them to do very specific and targeted experiences towards those house account holders.
There's a restaurant in New York City called 11 Madison Park. It's the #1 restaurant in the world, 3 Michelin stars. I ate there with a friend of the podcast, Colleen, before we left New York back for Cincinnati. It was kind of like a bucket list item to do. And although this didn't happen to us, I had heard through friends that there is one person at 11 Madison Park who their title is called the Dreamweaver, and it is their entire job to listen in to your conversation, like to eavesdrop on what you're talking about, what's going on, and make your experience like unforgettable. So one way that this manifested that I heard about was the Dreamweaver heard someone talking about how, yeah, this gold-crusted caviar or whatever is amazing, but I'm really just craving a hot dog. And they went down to a hot dog stand in Madison Park, which is where 11 Madison Park is located outside of, and got a hot dog, brought it to the chefs of 11 Madison Park and said, make this the best hot dog in the world. And they did. They made an amazing hot dog. And in between courses, they brought out this hot dog. And I think that kind of like personalization experience that happens behind the scenes that is very intentional and takes a lot of work to come up with is kind of the same feeling you'd get as a customer going in and not seeing or feeling that technology, but it just happening for you.
I love businesses that don't feel such an existential threat to continue to produce money, that they can focus on different aspects of the business like that, and I think honestly, inKind was born out of that level of comfort and flexibility, and I just love businesses like that because they tend to be more interesting, more unique, more experienced and consumer focused. I love that story.
All you have to do is charge $350 a plate, and then you can do
Right.
that too, Jay.
Luxury goods would be a great business to get into.
Couple other things that stuck out in this interview to me that kind of loop back to the beginning of where we started here with Johann as a founder is just how good he was about the numbers, about giving us great numbers, and about explaining key concepts and drivers of why this business model works by using numbers. Like, to me, that's like my dream come true. And it's what we don't really get that much on the podcast because I don't know why, but it's just maybe just not the way that most founders present ideas is by using numbers.
I think it comes with a level of experience too. It either comes with a level of experience of being an entrepreneur and understanding that you have to eat, sleep, and breathe those numbers to survive, or it comes from somebody that has like a hyper technical or mathematical background.
Yeah. Or as an investor, maybe he knows what investors care about and what they're going to do. So the number that stuck out to me the most was this 80% spend increase when they were using house accounts. So he said that this group of 55 people spent $31,000, and then after getting house accounts spent $120,000. And if you break that down, that means per person, they used to be spending in a year $560, and after we're spending $2,200. That's incredible because that same person is probably going to eat there regardless. And now they're just spending more. I think that is an incredibly powerful statistic.
And again, I don't have data to back this up. All I have is intuition. I believe that that comes down from a higher level of scarcity and loyalty programs that exist now in the culture. And I think a little bit of a thirst for it. You know, I've mentioned in the past on our Share episode that at this point, I'm really only loyal to my barber. But if I had a reason to be loyal to some other type of business, I would probably love that. And if you went the class pass model, which I would imagine a lot of investors would push Johann to do, I just think that evaporates. Like, I think that 80% spend increase is not going to be the case. I think it becomes Groupon.
Do you think if this is another shadow I have, do you think if every restaurant or even a critical mass of restaurants adopted inKind's house accounts that were specific for their restaurant, it would lose its luster as well?
I do, but I just don't think that this is for most restaurants. Like, I think this is for people like Kevin who have a background in Momofuku as a sous chef and then open their own restaurants that are incredible quality food from a well-known chef that can build loyalty around the food and not just be, you know, one of 5 restaurants that people say, hey, where should we go tonight? And it's on the list.
Quick aside on Momofuku. I was at Coachella in April, and one of the beer gardens had fuku in it. And have you ever had fuku, the fried chicken?
No.
Ugh, it is so good. I had it like 4 times. It was amazing. I am a big fan. It used to be in New York City. I think they're closing and reopening. But if you can't tell from the end of this interview, I'm a bit of a foodie.
Gross.
You like that?
I'm a bit of a foodie.
I don't know. I just talked about 11 Madison Park and fuku on a deal memo that we're talking about a company. So
You're right. You've had more varied and exciting food and drink experiences than I have.
you ate an onion like an apple yesterday.
I was hungry. I loved hearing the perspective of working with John Fine, who has been a guest on the show and helped make this connection. I think it's really, really powerful to say, I enjoyed this person so much as an investor that I asked to become an LP in his fund. That's really, really great validation.
I'm going to hit back on one number before we get to what we want to see in the next 6 to 18 months. But he was very open about the revenues that they have now. He said 400,000 MR run rate, looking at $1 million by mid 2019. That's kind of in line with what I kind of worked out, which was their 150 restaurants at 60K funding. That's 9 million. So I think there is a ton of room to grow. I think that they're doing it slowly, thoughtfully, and making sure that they have their use cases built out. They were talking about the coffee shop difference from the Utah diner difference, from the James Beard award-winning restaurant difference. And I think each of those have kind of nuances. There's also the geographical constraints of when you move to a new city. You don't have that user base built up that he was talking about. So I think you're going to see revenues. I guess this will be my 6 to 18 months. I guess that's what I'm doing right now. My biggest thing I want to see in the next 6 to 18 months is I'm kind of torn. It's either geographic expansion or it's proving the thesis that the user base in one city translates from one restaurant to multiple restaurants and makes more successful launches possible. What about you? What do you want to see in the next 6 to 18 months?
I'm looking at a couple of key learnings from their team. I want to see, are they experimenting in different types of restaurants or in different types of geographies? And are those converting at the same, are they having the same levels of success? I want to see if the restaurants that are already open 6 to 18 months from now, if they're still enjoying that same increase in spend after a year, 2 years have passed. What is the real lifetime value of this customer? And then, I'm looking at my friend revenue and number of restaurants that they're opening, because it's interesting. I wonder, to your point, if it is going to be kind of this clustered house account holders transfer to other restaurants that have house accounts, or if it's more successful just going to more of the hot Lola's chickens and Himitsus in different markets all over the country. Is it having a couple of house accounts in a city that ends up having the greater reward from having customers that spend 80% to 100% more?
Jay, we had a lot to talk about in this deal memo. It was a fun one. It's a relatable one. If people want to chat with us, where should they interact?
As always, guys, we'd love to hear from you on Twitter, preferably. You can tweet at us at UpsideFM. If you have something that's a little more long form that you want to send our way, you can email us hello@upside.fm. We'll talk to you next week. That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter @UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep on rhyming, find a way.